Well, my name is Jennifer Lowry, and I am with the Indiana Public Retirement System. And I am going to do an overview of your benefits today. As I go through, I am not going to be able to stop and read the chat. So if you do have questions, I can refer to the chat at the conclusion of the presentation and double back and answer your questions. Okay. If during the course of the presentation, I say something that's contrary to the Indiana codes that govern the JRS system, of course, it's going to be the code that will take precedence over what I say during the presentation. Now, the JRS system is comprised of two retirement plans. There's the 1977 plan that judges who were employed prior to September 1st, 1985 will be a part of that plan. If while in the 77 plan, you separate from services and then you're rehired after August 31st of 1985, you will still be a part of the 1977 retirement plan. For judges who began employment after August 31st, 1985, you will be a part of the 1985 Judges Retirement System. Anyone who was a full-time magistrate as of July 1 of 2010, you will have the option of electing to participate in the 1985 JRS system. And once that election is made, that is irrevocable. Anyone who was a full-time magistrate after July 1 of 2010, you will automatically be a part of the 1985 JRS system effective January of 2011. Under the JRS system, there are three different benefit types. There's a retirement benefit, a disability benefit, as well as a survivor benefit. Contributions that fund your benefits through the JRS system are comprised of both an employer contribution as well as a member contribution. The employer contributions don't contribute, or you won't see those funds reflected in the member's account, and the employer makes the contributions on an annual basis. Members, however, contribute 6% of their compensation for the first 22 years that they are serving in a position that is covered by the JRS system. How is service credit earned? In order for you to vest in the JRS system, you have to have 8 years of service in a covered position. You accrue service by the month. If you work a day in a month, you will get service credit for that month. Once you've accumulated enough service to equal 8 years, again, you will be vested in the plan. We're going to talk about what it means to also have partial years of service at the time of retirement. You are still going to get service. You're going to get service credit for those partial years and pay, but the pay is going to be prorated for any partial years of service you have at the time of retirement. If during your tenure as a judge, you are called up to active military service, as long as you return to your covered position after being honorably discharged from active military service, the time you served as in the active military, that will also count towards your service credit. You can also receive service credit if you're away from your duties on FMLA. The plan also allows you to purchase service. Once you have achieved 8 years of service as a judge or magistrate, if you have non-vested or unvested service in one of the other Indiana public retirement plans, you can purchase your non-vested service toward your DB benefit at retirement in the JRS system. Let's talk retirement benefits. When you're ready to retire, you can retire on any day of the month you choose. Your retirement benefits would begin the first day following your last day of employment as a part of the JRS system. When you're applying for benefits, you want to make sure you submit your application in a timely manner, because we cannot begin benefits more than 30 days before MPERS receives your retirement application. Long story short.
Here. It's a bigger problem.
Can't hear. I hear someone saying that they can't hear me. My mic is not muted, so everyone else, are you guys able to hear me? And if you can, if you want to just give me a nod. If you can't, let me, everybody else is good. Okay. Um, as I was saying, if you want to make sure you receive all your benefits, we'd like you to submit your application at least 3 months ahead of your intended retirement date. The plan allows you to submit it at least or up to 6 months ahead of time. So again, just keep in mind, if you submit your application more than 30 days after you have left service, we can only go back up to 30 days prior to receiving your retirement application. Benefits are paid on the 15th of each month. So once you retire and you start that process, you can expect money in your account on the 15th of every month. I tell people in other presentations, we talk about the fact that we send out more than 160,000 checks each month. And I always tell them, I can't wait to be 160,001. Although I love what I do, the thought of every day being my own sounds pretty good. In the JRS plan, in order to achieve normal retirement, which means you're going to receive full benefits, you have to be age 65 along with having at least 8 years of service. You can also qualify for full benefits in the JRS system by meeting the Rule of 85. The Rule of 85 says that you are at least 55 years of age and your age in service with the JRS system equals 85. If you'd like to take benefits prior to reaching normal retirement, you can take benefits early. Early retirement can occur between ages 62 and 65 with at least 8 years of service. The way we're going to determine how much you receive each month, we're going to look at the salary being paid for the office you held at the time you ended employment, and then we're going to multiply that or look at the number of years of service you had at retirement. There's a percentage associated with your years of service. If you have 8 years of service, you're going to receive 24% of your benefit. You're going to get 27% with 9 years, 30% with 10 years, 33% with 11 years. Once you hit 12 years of service, your benefit jumps up to 50% of the pay that you were receiving for the position you held at the time of retirement. Between 12 and 22 years of service, the benefit can increase up to a maximum of 60% of your pay with 22 years of service. If you decide to retire and you want to retire under the early retirement benefit, we're going to calculate your total benefit the same way, but there's going to be a reduction of 0.1% for every month that you retire preceding your 65th birthday. Once that reduced benefit has begun, the benefit will stay reduced for the rest of your life. Plan also provides for disability benefits. In order to receive disability benefits under the plan, 2 licensed and practicing physicians that have been appointed by the MPERS board has to certify that you have sustained a total and permanent disability by reason of physical or a mental infirmity, and that the condition is likely to be permanent. If that condition is met, disability benefits will begin. Once disability benefits have begun, you will be re-examined at least annually by 2 physicians, again appointed by the MPERS board. If those physicians determine that the disability has ended, then benefits will cease. If you are at least 65 or you have met the Rule of 85 at the time they find that the disability no longer exists, then your payments will continue, of course, under the retirement benefit. We calculate your disability pay. If, again, you become disabled, We're going to look at your salary at the time your employment ended. We're also going to multiply a percentage by the number of years of service you had at the time of your disability. Unlike retirement, if you have between 0 and 12 years of service at the time you become disabled, you will receive 50% of your pay. Your pay will then begin to increase based on the additional years of service you have in the plan, up to the maximum of 60% with 22 years of service. Plan does also provide a survivor benefit. Whether you're in the 77 plan or the 1985 retirement system, your spouse, child, or children would be entitled to a survivor benefit if you passed away while receiving retirement benefits, or if you were still serving and you had at least 8 years of service under your belt, or even if you had your 8 years and you'd left service, as long as you were entitled to a benefit, your survivors would still be entitled to a benefit as well. If you died while receiving disability payments, your spouse or children would also be entitled to a survivor's benefit. Survivor benefits would be equal to 50% of what you were receiving at the time of death, or a minimum of $12,000 annually if you passed away after July 1st of 1997. The survivor will get the higher of the two. Now, for a spouse, that benefit will continue for the rest of his or her life. A child will age out at the age of 18, unless that child has a disability of some sort, then the benefits could continue beyond age 18. Reemployment after retirement. If you've retired from the JRS plan and you are receiving benefits and then later decide to return to the bench, your retirement benefits will be suspended and you will be re-enrolled in the plan. You will continue making your 6% contribution until you've hit 22 years of service, at which time they would stop. And once you left for the second time, you would have to resubmit a retirement application, and we would recalculate your retirement benefits based on the salary that you held prior to your latest retirement. Pre-retirement benefits. If you leave your position prior to starting retirement, if you're in the 1977 retirement plan, you would be entitled to a refund of your benefits if you terminated as a judge and you had less than 12 years of service at the time. If you're in the 1985 JRS system and you terminate service as a judge or a magistrate for any reason other than death or disability, and you have less than 8 years of service, you will be entitled to a refund of your employee contributions. If you take a refund of your contributions at the time of termination, you're going to forfeit your future pension benefits. So if you take that money and then later you return as a judge and you want to have your service reinstated, you will be required to repay the amount of the refund you took plus interest that will be determined by the IMPERS board for you to get, again, credit for your prior service. When you take a refund of your employee contributions, you can have those dollars paid directly to you. When you have the refund paid directly to you, you will be responsible for federal, state, and county income taxes. The IRS does require that we withhold 20% right off the top, so they will receive the 20% before the deposit is made into your account. The state and county taxes are optional. You can also opt to have a rollover. You can do a rollover for the pre-tax money, and then you would have any post-tax money that's in your account. Those dollars would be paid directly to you. The plan would also allow you to do a partial rollover. The partial rollover would have to be a minimum of $500. Your last option for a distribution of your employee contributions would be for you to have those payments returned to you in the form of a monthly installment. Again, whenever you take a distribution that is paid directly to you, we are required to withhold 20% for federal income taxes. If you take a distribution, again, paid directly to you prior to age 59 and a half, you may also be subject to a 10% premature distribution penalty that is assessed by the Internal Revenue Service. If you fund it, because you have funded the employee portion, the 6% that you've put in has already been taxed. So if you do take a distribution of those funds, you will not be required to pay taxes on any funds that you have previously paid taxes on in prior years, or at the time you made the distribution, or I'm sorry, at the time you made the contribution. Our website, of course, you've had a lot of information thrown at you just now. If you like to read the handbook and dig in a little deeper to various subjects, you can find the handbook on our website. In addition to the handbook, you can also access forms. You can find our event calendar as well as other publications to keep you abreast of what's going on in the plan. If you like to access your personal information, you can do that by going to the www.myimpursretirement.org website. There you will be required to register. Once registered, you would have access to the application. You would have access to your payment history, tax documents. You can also update your demographic information, your address, your telephone number, your banking information, as well as withholdings from your monthly pension benefit check. When you log on to that MyImpers website, you also have access to some planning tools. If you're just trying to determine whether or not you can afford to retire, there are some tools out there available to let you do some planning ahead of time. Again, you can also access the retirement application when you log on to the www.myimpursretirement website. We do not accept paper applications, so the only way you can apply for retirement is by doing the application online. Again, we'd like for you to apply for benefits 3 to 6 months ahead of your intended retirement date. The furthest out you can apply is 6 months. We'd like you to do it at least 3 months in advance. That's what's going to guarantee your on-time check. How do you apply? Again, you can log into your account and you can complete the retirement application yourself. If you don't feel comfortable completing the application yourself, you can always schedule a one-on-one appointment with myself or one of my colleagues. During that session, we will go through the application, make sure everything is completed and submitted. You can set up an appointment in person via a video chat or a phone appointment. If you decide you want to tackle that application yourself and find it to be a little bit more challenging than you anticipated, you can always contact our call center. The member services advocates will be happy to assist you. If you have questions beyond their capabilities, they will also schedule you an appointment to meet with, again, me or one of my colleagues to assist you. If you'd like to contact us for any reason after this presentation, here is all of our contact information. If you have questions and you would prefer just to email those questions, you would send them to questions@impers.in.gov. If you'd like to speak to someone, you can contact the member services team Monday through Friday from 8 a.m. to 8 p.m. You will get a live person. If you want to write us, we will write you back. However you like to contact us, we will respond in kind. Now, if you have someone like me at home who's going to question everything about your retirement benefits. This is being recorded. I believe you're going to have access to this information again, so you should be able to listen to it again or over and over until it all sinks in, or share it with your loved ones so that there's an understanding of what you can expect. There are also videos on YouTube if you do want to try and tackle the application that will help you log in as well as access that application. Any questions? If you're like me and I'm not no tech, I'm just low tech. So if you'd like to unmute yourself and just ask a question, please feel free. I'm not sure where they're going to post this video yet, but I can find out and have that information. I'm going to talk with my manager and see where they're going to post it, and I should be able to get that information to Valerie. I'm going to switch to the chat to see if there's any questions out there. But again, if you have some, you are certainly welcome to unmute yourself. Does service as a senior judge constitute reemployment? If you reemploy as a senior judge, they don't continue to add to your service. And I was reading up on your plan, and I believe they're going to stop the benefit. Just a second. I don't want to make assumptions. I had the information all pulled up because I knew you guys were going to ask me some questions that I wasn't going to be able to answer right off the top of my head. Cannot wait. Senior judge, I know the service does not count for additional, but you may be entitled to additional. So just 1 second and I'm going to look. I had all of this set up and prepared to access quickly until my system went haywire and I had to reboot. You can reset, okay. And I saw the other question that's in the chat. I am just researching the reemployment question to get you an answer. And it did not address the senior judge there. And I do remember the answer. I just had to think about it a little bit. If you go back into a position that is covered by the plan, that's when the benefit stops. If you come back as a senior judge, your benefits will not cease. They will continue. I came in a little late. Once retired, the retired judges get the same. Yes, if you retire, if sitting judges receive an increase, retired judges will receive the same percentage increase as sitting judges. I was in city court. I was a city court judge for 7 years. That position did not pay into perf. Can I buy time later? When you say did not pay into perf, are you really talking perf or the judge's retirement system? You cannot combine years of service from different plans. If you were a judge and you were participating you had PERF service prior to becoming a judge and you're not vested in the PERF retirement plan, once you have 8 years as a judge, you can circle back and purchase the service from the PERF plan toward your pension benefit. If you're in the 85 plan, again, that service doesn't count toward vesting, but it will count toward increasing your pension benefit. If you have some inaccuracies in your plan, you'll just want to contact our service center, tell them your concern, and they will assign a rep to review your service. If you are employed and I'm assuming you mean judge service as a judge, you should have obviously been enrolled as soon as you started your employment in a JRS covered position. And so there should be records to confirm when that occurred. So it should be an easy fix for the JRS system. Now, if you're talking service for one of the other plans, again, we can start the process, but as soon as you were enrolled in any of our covered positions, you should have been enrolled on the first day you became eligible for those benefits. And we do have the ability to talk to your employers to see how we could fix a discrepancy. Are there any charges? I'm checking to see. Yes, and I think I answered that question about the senior judge. You can. Are there any other questions I can answer for you guys? I don't see anything else coming up in the chat. If there are no other questions, I'd like to thank you for your time this afternoon. I hope that it was a good use of your time. And again, if you guys have, oh, I think we got some new questions. Oh, you're welcome. So if you guys need to meet with me or again, one of my colleagues, if you have questions you'd like to ask in private, we are more than happy to assist you. And again, those meetings can be in person, virtual, or over the telephone. When you're ready to retire, don't hesitate to contact us. We'll be happy to assist you with your application and any final questions you may have prior to leaving service. Thank you. You guys have a great evening.
Okay, now it's my turn. I'm Greg Strack with InPERS also, and I'm going to talk to you today about the Retirement Medical Benefits Account. And like Jennifer, I'm kind of low tech, so if I screw up here a little bit, don't be afraid to yell at me and tell me what I'm doing wrong, okay? Hopefully you can now see my screen that says the Retirement Medical Benefits Account on it. If, as we're going through this, you have questions, you can save them up for the end, or if it's pertinent enough and you want to get an answer, interrupt me. That doesn't bother me. Take your phone, your microphone off of mute and turn it on, and we'll try to answer your questions as we go through this. Well, now if I can get it moving, we'll be all set. There we go. All right. Back in 2007, the Indiana legislature created a benefit that they asked for it to be on a pre-tax basis. And this benefit is what's called today the RUMBA account, or the Retirement Medical Benefits Account. So it came into being in 2007. Who's covered by this benefit? The following individuals are basically employees of the executive, legislative, or judicial branches of state government, which judicial would include most of our listeners here today. However, as the Indiana legislature often does, they don't like to leave things alone. So in 2011, they made a couple of exceptions to that. The exceptions were for state police and conservation and excise officers. Excuse me. The reason being, the police officers have a medical plan that they're eligible to go into in retirement. And therefore, the legislature said that benefit was good enough for them, and they didn't need the Retirement Medical Benefits Account. Now, with this plan, as an active employee, you are a participant in this plan as a full-time active employee. However, only retired participants and covered dependents are entitled to receive benefits from the plan. So while you're an active employee, you accumulate monies into the benefit, but once you have to be retired to begin using it. One further thing I'd like to mention here is Jennifer talked a little bit about purchasing prior service and all those other things. It's important to note for this benefit, for the retirement medical benefits account, purchase service credits may not be included in determining your eligibility for the retirement medical benefit account. So let's suppose you're eligible for an unreduced retirement and you're a year away from having unreduced retirement. And you purchase a year of service credits so you can get unreduced retirement benefits. However, that would preclude you from being eligible for this benefit because you have to earn it through your actual service and not through purchase service credits. So, how does the plan accumulate money? You do not put any of your own money into this account. The state makes the contributions to your account. And each year on June 30th, the legislature said that once per year, the state was to put money on, once per fiscal year, the state was to put money into your account. The fiscal year runs July 1 through June 30th, so the state elected to put it in on the last day of the fiscal year, obviously, okay? And the way it works is, if let's say you're age 35, then you would get an $800 contribution. When you turn 45, you would get an $1,100 contribution. So when you're in your 40s, you get $1,100. When you're in your 30s, you get $800. Once you receive 50 and above, the annual contribution is $1,400 per year. Now, when they created the benefit back in 2007, they said, boy, this isn't very fair to that 30-year employee who's going to retire a year from now. He's going to have one annual contribution of $1,400, and that's what he's going to get. So they created what they called the bonus contribution. And they said if you have at least 15 years of state service or 10 years as an elected or appointed officer, and you were an employee on the state on 7107, and you have continuous service, no interruptions, then you'll receive the product of $1,000 times your years of state service credited to your account. So this was back in 2007. They said if you had, for most judges, 10 years elected, and you've been an employee since 7107 without interruptions, and let's say you had 20 years of service, you would have gotten $20,000. So that was to last for 10 years, the first 10 years of the program, to help people who had long-term service build up a little bit of money into their account a little faster than through the annual contributions. However, as time came quickly upon us for the expiration of this bonus contribution in 2017, the General Assembly and some employee or the powers to be of the state said, hey, wait a minute, we're going to lose a lot of employees. There's a lot of people that are going to retire June 30th of 2017 in order to get that bonus contributions. So once again, they made some changes. So what they said was, and what is in effect today is, if on June 30th of 2017, you are eligible for a normal unreduced retirement, have at least 15 years of service and no interruptions in service after 7/1 of 2007, or 10 years as an elected official with no interruptions, then your RUMBA benefit will be frozen as of that date. So they created these frozen accounts, and you will receive the amount, let me back up a little, including the $1,000 per year service bonus. and you will receive that amount upon your retirement from the state. However, you will receive no further contributions to your account if you continue to work past June 30th of 17. So what they said was you're going to get the bonus, that $1,000 for every year of service, but you're not going to get any further annual contributions, and you're not going to get the bonus for any service after 2017. So it's going to be frozen as of that date. Now, what if you didn't meet those qualifications? You will continue to have the annual contribution credited to your account each June 30th. And when you ultimately retire, you'll receive the accumulated annual contributions. However, you will not receive the $1,000 per year of service bonus when you retire. So you had to meet the criteria on June 30th of 17 to get the bonus. If you didn't, you will no longer get the bonus when you retire. You will receive only the annual contributions. Couple of examples. The first one's pretty straightforward and simple. I'm not going to bore you with reading it. Basically, someone is 45 years old and it comes time for the annual contributions and they got $1,100 credited to their account. The second one's a little bit different. This is someone who met that, had a frozen account as of June 30th of 17. So her frozen account amounted to 10 years of annual contributions, starting with the first one in 08 and all the way through 17. That's 10 of them for $14,000, $1,400 a year. And she had 30 years of service, so she got $1,000 for each year of service. That's $30,000. The two added together are $44,000. She had the frozen account, and that's how her account is computed. So once you have this money, and once you figure out how they've come up with what might or might not be in your account, because everyone's different with their start dates and all their other comings and goings and what might or might not happen, what do you do with the money? They're to be used to pay for premiums for individual or group health coverage or long-term care provided by an insurance policy for the retired participant, spouse, and dependents. Please note it says, and your spouse and your dependents. Dependents being defined as someone eligible for the state's health care, not necessarily on the state's health care, but someone being eligible for it under your employment. So if something should happen to you, your surviving spouse and dependents are allowed to continue using this account until the dependent is no longer eligible, like if they're a young child. Once they reach age 26, then they're no longer eligible for this. Your spouse is eligible for it until they should happen to get remarried, and then they lose their eligibility. Monies in the account are forfeited when the member dies without a surviving spouse or dependents. Termination of employment prior to becoming qualified as a retired participant under the plan, or death of a surviving spouse and dependents no longer being considered a dependent. Okay? The Affordable Care Act, it probably doesn't, this probably doesn't apply to a whole lot of you, but sometimes when an employee retires before the age of 65, they think they'll take this retirement medical benefits account and then apply in the marketplace for coverage for healthcare under the Affordable Care Act and get the credits applied to it and get a little bit cheaper insurance that way. The Affordable Care Act says that this is considered minimum essential coverage provided by an employer or former employer, and you need to identify this when you apply for coverage in the marketplace. If by chance you should get credits and use them and still have this, the IRS can come after you and attach penalties and fines and all those wonderful things that they have the capability of doing. So I don't recommend you try to trick them. Now, the Retirement Medical Benefits Account Plan Handbook, for those of you interested, it is available at the website. I normally say here, if you want to fall asleep at night, it's wonderful to try to read, but yeah, since most of you are used to reading lawyer ease things, type of things, it might be interesting to you. So it is available to look at if you want to there. Key Benefit Administrator, our FlexPro KBA, is the third-party administrator of this plan. They're the record keeper of your account balances, and they process the claims weekly, daily, monthly for us as you submit claims in retirement for reimbursement. When you retire, enrollment happens automatically for this benefit. That scares some people because they used to filling out paperwork to make sure they get it. You do not have to complete any forms on retirement for this benefit. What happens is NPERS notifies key benefit administrators of the upcoming retirees. Approximately 60 days after retirement, the state will send the information to KBA. Now, I say it's approximately 60 days. It depends on what time of the month you retire, how all the paperwork gets processed. Sometimes it takes up to 30 to 60 days for us to even be notified you've retired. And then that clock starts over again for the processing of all the paperwork. So it can take a while for this to happen, but if you get nervous about it, we'll look into it and find out if something's going on, make sure you're not getting overlooked, and we'll make sure everything gets handled for you. A welcome packet is generated finally once we're notified of your retirement. The welcome packet consists of the main thing is a letter to you congratulating you upon reaching retirement and having this benefit. In that letter will be down to the penny how much money is in your account. There will be frequently asked questions and other paperwork to fill out. Direct deposit form is in there so you can have your reimbursement directly deposited into your account if you should so wish. If not, you'll get checks mailed via snail mail to you, and it will take some time to get there. One important form there, the retiree registration form, please try to remember to complete that. On that, we ask if you have a spouse. That identifies who your spouse may be so that it makes a transition to them easier if that should ever be necessitated. So when you request a reimbursement, we have to have the signed claim form. And the claim form basically just asks you what you're paying for, and they ask for a copy of maybe the face page of the insurance and proof that you paid it, and then the signature. So if you have Medicare, you don't have a face page of what Part B that they take out of your Social Security check. And so Medicare doesn't care. They're not going to send you that face page. But they do once a year. Social Security sends a letter to recipients, and it tells them what their new benefit's going to be for the next coming year. You usually get that in December for the forthcoming year. And then it also shows how much is going to be withheld for Medicare Part B, or if you have it Part D, if you wish. We just need a copy of that letter as proof that you have it and how much they're taking out of your check. Supplemental policies, you obviously would have a copy of that. And same way, if you're not eligible for Medicare, you would have a copy of the policy that you've purchased. Now, what happens if you're still working for another employer, or if your spouse is still working with group coverage? That can be reimbursed as long as it's being paid post-tax. Because remember, at the very beginning, we said this benefit was tax-free. So if it's tax-free and you get reimbursed on something that's tax-free, you know what's going to happen? The IRS is going to say, oh, you're getting tax-free money. So you can't do that, can't have it both ways. So it has to be paid post-tax. So if you're working for another employer, you have to get a letter from that employer stating that it's post-tax and not pre-tax. Proof of payment used to be real simple with canceled checks, but some of us remember canceled checks, but they're a thing of the past today. But you can, go online if you have a bank account that allows that you can print a copy of the canceled check online. You have bank statements, credit card statements, so forth. We really don't care on your bank statement or your credit card what you're paying for or what you're spending your money on. So if you want to black anything out, please feel free to do so, except for the one or two lines that might apply to the insurance premiums. So each month a claim is requested. The retiree should provide a signed claim form, proof of payment, and proof of insurance. Monthly submissions assures KBA and the state that the retiree and the eligible dependents are not deceased. So you don't have to submit a claim every month. Some people submit claims they save them up and submit them at the end of 3 months. Some people say, I don't want to get reimbursed every month. I want my account to last longer. So I'm only going to submit a claim every 2 months or every 3 months. It's your account to manage, but we don't assume that because you've bought a policy that you're going to submit the claim every month, because trust me, there are some people who do not. So you have to submit the claim if you want reimbursement. Also, it helps us make sure that you should still have an active account and something hasn't happened to you and your survivors. And KBA will send a letter to you and they'll say it a lot nicer than I say it. And it will just basically say, hey, are you still with us? Services must be incurred before they are eligible for reimbursement. So what that means is, let's take, for example, you buy vision insurance in retirement. Normally, that's not near as expensive as, let's say, medical insurance. So you might say, I'll just pay that for the full 12 months up front. We can only reimburse you month by month as it goes forward. So if you pay for the 12 months up front, July 1, and submit the claim on July 15th for all of it, we'll say, nope, we can reimburse you 1 month at a time. Now you can save it up and at the end of the year, submit it, and then you would get the full 12 months reimbursement. So it's up to you how you want to do it, but once again, the IRS enters into it here. They say that if you prepaid a 12-month policy, you do have the option to maybe cancel it at the end of 6 months. If you cancel it at the end of 6 months, you get a 6-month refund. And then you've already submitted the claim for 12 months, and then you're getting more money back than you should. So they won't allow that. Now, the other thing we want to touch on here, senior judges. If you retire and become a senior judge, that means that you have returned to active employment with the state. The Affordable Care Act says this benefit can only be used by retirees, only retirees. So as a senior judge, you're now active. So what happens is the usage of your account gets suspended while you're a senior judge, and the money waits for you. It doesn't disappear. Excuse me. But while you are a senior judge, you cannot use this account. Contact information. There we have some phone numbers for key benefits. We have some websites here. Okay, NPERS website is there. Now, one of the questions that always comes up, how do I know what's in my account? You can go to the NPERS website shown here, and at the bottom of the first page, there's a little section for the retirement medical benefits. When you click on that, it takes you to another screen, and there will be an option for you to set up logins and check my balance. You will set it up as an active employee until you retire, and then you have to set up another one as a retiree because your balance is kept separate when you're active versus retired. Now, what happens though is people check that, and for some people who don't have a frozen account, that's fine, and it shows how much is in their account. It shows the annual contributions, it shows the earnings that the annual contributions have accumulated plus or minus, and gives you a grand total. However, if you have a frozen account, it will only show maybe that you have 14,000, and then you're going to be on the phone calling me up saying, oh, hey, this thing's wrong. I've been elected judge for 30 years. It only shows 14,000. The reason for that is the bonus contribution, the $1,000 per year of service, does not get added until you actually retire. So it doesn't get added until retirement. So if you're eligible for a frozen account, and if you're eligible for the bonus in that frozen account, if you look at your account online, you're going to be disappointed, and it's not going to show what you think it should. And that's okay, because the bonus does not get added until you retire. So that's so much for my presentation. I'll see. Let me see if I see anything here. I don't see any questions. Maybe I'm missing them.
Thank you, Greg, for clearing up what happens. Okay. Thank you for clearing up what happens when a senior judge goes back to work. I was thinking that the payment stopped, but it was the health insurance benefit that would stop. So thank you for clearing that up.
Yes, yes. Okay. I think, let me see if I see anything else here. No. When you were a state prosecutor, yes, there were contributions should have been made into your account. Yes, the first annual contribution was June 30th of 2008. So that would have been the first one. And perhaps since you were an elected prosecutor, if you had 10 years, you could have a frozen account. Your situation, it all depends on exactly how much time and service you had in both programs. You accumulated service and money through both the prosecutor and the magistrate. So yes, you should have some money in there from both service. The state does not, once you're a senior judge, the state does not make the $1,400 annual contribution into your account. That is because you have to, this benefit is for full-time employees, and senior judges are not considered full-time. Plus, as I kind of say, you get one bite at the apple. Once you retire and have this benefit, have an active retiree RUMBA account where you can submit claims, even if you're a senior judge, you can no longer accumulate money into the account. You get the one bite at the apple. Okay, I think I've answered most of the questions that I see there. And I thank you for allowing me to be with you. And good luck to you. Thanks.